what's been going on more recently. And this is a sort of talk which I've given a couple of places, which looks at that. That's why it's got the word global vision on it. It's because it was part of a series of lectures I gave called Global Vision Lectures in China a little while ago. But anyway, the topic really is crisis. I say what crisis, you can say which crisis. So what I want to do is I want to look at some interrelated crises which have been going on, and they often get muddled and confused and put in the same bin. So I just want to make sure that it should be fairly clear what's going on. And afterwards I'll also have a little look, which I haven't prepared any slides, but I've got some things to show you as to what's going on at the moment in the UK and the US in terms of budgets and so on. So I'll try and entertain you a little bit, and I'll try and do it in a fairly simple way, so there won't be any equations here. So I want to, and I'm going to describe three different crises here. I'm not going to spend much time on the first crisis, which is the banking and financial crisis, which happened in 2008. But that crisis gave rise to a second crisis, which was a fiscal crisis of unsustainable deficits. And then it gave you a third crisis, which you can think of as Eurogeddon, or the Eurozone crisis. So there are three distinct things. They're all related to each other. Crisis 1, in a sense, gave rise to Crisis 2 and Crisis 3, but they're all sort of different. After the crisis, we've got quantitative easing and the merging of fiscal and monetary policy. I'll talk more about that next week. I'll be looking at monetary policy since 2008. So I'll talk more about that next week. And then we'll look a little bit what's going on now. In the last year or two, and what's likely to happen in the next few years. So if we go back to the first crisis, so we know that banks are financial intermediaries. For those of you who did CIA, contemporary economic issues, a couple of years ago, we talked about this. Just to remind you, people deposit money in banks, banks lend out money, etc. The basic problem of banks, the fact that they want to, bank loans are long term, they last for a long time, whereas deposits are short run deposits that can be withdrawn at any time. This means you've got underlying fragility. The banking system can only work if people have confidence in it and people behave predictably and don't make sudden demands for cash. So it's all based on confidence. And there's always a possibility that confidence will break down, even if banks are behaving themselves, and you can end up with bank runs. Basically, banks make money by lending money, lending out money, and there's an interest rate differential. They lend money, they make long-term loans, they charge higher interest rates on their loans than they have to pay on their deposits. So they want to keep as little reserves as possible, and so if they've only got, they've got an incentive, if you like, to have as small a reserves as possible, which makes them liable to these possibilities of bank runs. So Walter Bagehot introduced the idea of lender of last resort back in the late 19th century. He was the governor of the Bank of England, and the idea was that you should provide liquidity to solvent banks at a penal interest rate. So solvency, again, we talked a little bit about solvency when we looked at sustainability. So a bank is solvent if its assets equal its liabilities in the long run. So it has the ability to repay all of its liabilities in the long run. But due to a mismatch of maturities, it may be difficult for the bank to meet demands for. They might not have enough liquidity to meet demands for repayment of its assets in the form of deposits. So Bagehot said, well, if a bank is solvent but doesn't have enough money, the Bank of England could come in and lend them some money at a penal interest rate. Penal interest rate meaning an interest rate which is higher than the market rate. Why a penal interest rate? Well, you want to discourage banks. There's this notion of moral hazard. If banks can get easy money very cheaply, then they've no incentive to try and avoid going to ask the Bank of England for money, and so there's no incentive for them to behave well. That's what's called moral hazard, and that's why it should be done at a penal interest rate. So this all worked, this lender of last resort idea. The bank has large gold reserves, well, had in the past, and it was able to meet various financial crises in the UK and elsewhere. In America didn't have a central bank until about 1913. The immediate cause of it having a central bank was the San Francisco earthquake. So why is the San Francisco earthquake relevant? It's relevant because there was a big demand for funds to rebuild San Francisco. So insurance companies started going bust, and that caused there was a great demand for money, and the insurance companies had to pay out lots of money. They wanted lots of money from their banks. So the banks in America started folding because there was a big demand for liquidity. This took a long time to sort out, and in fact the Bank of England was involved, because at that time the Bank of England held most of the gold reserves in the world, or a lot of them anyway, a big proportion of them, and they had to, some of them had to be shipped over in boats to America in order to solve the problem. Anyway, after this, the Federal Reserve was set up. So that's a quick history of banking. What's that got to do with fiscal policy? Not much, but we'll just do a little bit more. If we look at banks' balance sheets, this is something which should be familiar with you from a couple of years ago. Most of the liabilities of banks are to the UK private sector. The figures would look pretty much the same today. And to other banks. So banks, most of their liabilities, what they owe people, what people have deposited there, and what's been deposited there is primarily the private sector, households, firms, and so on, and also banks. So banks deposit stuff at each other's places. And most of their assets are the advances they've made. That's loans to the private sector, the loans of banks, loans to firms, households, and so on. So that's, if you like, the bank's balance sheets. Now, what happens in the first crisis was that the value of a lot of assets fell. So this was, what sort of assets are we talking about here? Well, it was primarily, at least at first, assets which related to the housing market, mortgage-backed securities of various kinds. And it was systemic in a sense. It affected many banks across Europe and the US. So you had the banking system, as a result of the fall in house prices, a lot of these assets that were based on the value of houses fell. So banks were in a situation where they had their assets were now less than their liabilities. So there's various things that banks that banks can do to mend their balance sheets. Okay, so it doesn't necessarily mean they have to go bankrupt straight away. They can try and rebuild their asset sheets, but the point is that it takes some time to do that. They pay out less dividends, they can sell off some assets, they can do various things to try and rebuild their balance sheets, but in the short run, these things tend to take time. And so Japan had been through a similar sort of crisis back in the late 80s, 89, 90, and they still hadn't recovered by 2007, by the time that the crisis hit the Western countries. I remember going to a meeting at the Bank of England, and just shortly after the crisis, it must have been about 2009 or something, and there were all these guys from the city were saying, oh well, we've had a crash, output's gone down. Well, it's starting to recover. It'll all be over very quickly, and we'll be back to normal in a year or so. But there was a guy, Richard Koo, who was an expert on the Japanese, said, no, hang on a minute. This is a balance sheet recession. It's going to take financial institutions a long time to rebuild their balance sheets. And it could go on for a decade at least. He turned out to be right, and the other guys were all wrong. But anyway, that's it. I'm not going to say much more about this crisis. It's probably been covered elsewhere in your course, I hope. And if not, you'll have read about it or seen the films. The Big Short, The Wolf of Wall Street. There's lots of stuff about this. And really, what I want to focus on is not so much the crisis itself, but what followed next. Okay, so I'm going to look at two things. So one of the effects of the crisis which it immediately gave rise to was the problem of budget deficits, which ballooned in most of the countries in the West, at least. And secondly, the Eurozone crisis, which happened a little bit later. And we can return and just to focus a little bit on how this thing, it's sort of more or less over in the UK and the US now, in the sense that our deficits have come down to fairly normal levels, as those of you who are aware that heard the Philip Hammond yesterday talking about, and we'll look at some of the figures in a little bit more detail on that. So let's talk about two. So as a result of the financial crisis, output in most Western countries fell. Now, it didn't fall by a massive amount. What do I mean by massive amount? Well, a massive amount would be like in the Great Depression of the 1930s, where it fell by 25%. That would be a big fall. It didn't fall by anything like that, but it did fall. And this caused, and you can see in pictures of the UK GDP, there's a little bit where it went down. But it was enough to cause large budget deficits to occur. Why? Because there was a big fall in revenue. And also, to some extent, an increase in expenditure, because when people become unemployed, lose their jobs, or various things like that happen, usually there are often some expenditures like unemployment benefit or whatever it's called now, job seekers allowance. There are various welfare payments tend to increase. But for those the budget deficits sort of went up. So we can look at here's the budget deficit as a percentage of GDP. And we'll come up with the figures. The blue bit is the post-crisis. So if we look at the budget deficit as a percentage of GDP in the period, what is a sort of normal level? Well, you can see sometimes it's been 5%. Briefly, it's been 6%, but only for very, very brief periods. So if you look at the post-war period, really, on average, it's been maybe a couple of percent. Sometimes it's been in surplus. There's a surplus at the turn of the century. Remember, we saw that for the US as well. But it shot up to over 10% for a period in the UK, which has never been at that high level in peacetime. It's never been at that high level. So it's quite a large shock and a sustained shock, which meant that the UK budget deficit was high for a long time. And governments have tried to reduce it since then by a variety of measures, and they have, at long last, brought it down into more reasonable levels. So if we think of like a 3%, if we go to the Stability and Growth Pact that we talked about last week, that would suggest what a reasonable deficit might be, 3% or less. Well, we only really reached that last year or this year, depending exactly how you measure it. So it's taken basically almost a decade almost exactly, for us to get from where we were before the crisis to back to there. Now, it may be that in fact our budget deficit needs to be a little bit smaller because growth projections for the UK have gone down. But we'll come back to that a little bit later. So we can just look at here are some deficits. I've taken this for a few countries. There's some if you want to see these figures, the IMF have a very good publication called Fiscal Outlook, which contains all these things. It's very good because it does it in a consistent way across a wide range of countries. So it's a very useful document. They didn't used to publish it, actually. They only published it since the financial crisis. Anyway, so if we look at the UK, what's the average deficit? A negative figure there means it's a deficit. I think there's one or two positive ones there for the Germans, of course. The first column gives you the average deficit for a few countries. So for the UK, it's minus 1.4. US minus 3.1. It's a bit bigger in the US. Germany, bigger than the UK, minus 2.2. France, minus 2.7. So it's at that sort of level, 1, 2, 3% sort of average. If we look at the whole euro area, this will become important a little bit later. It's 2%. So that's the whole euro area. Although obviously there's quite a lot of heterogeneity within the euro area, as we will discuss now. The crisis hit. Normally, it's if you look at output, you have a big negative, a big output gap, negative output from the period 2008 to 2010. So there's a clear crisis period, if you like, and then you've got the aftermath. Well, you can see for the UK, the average figure over that period was much bigger, minus 8.9, 9%, which, as I say, is a huge deficit to have in peacetime, a 9% deficit. So, this is in terms of GDP. US, it was even bigger. The euro area, it was relatively modest. It was 5%. That's not surprising because, if you like, the epicenter of the financial crisis were the big financial centres of London and New York. And so you would expect the British and the American economies to be much more affected by the crisis than others. And indeed, banks in France, Germany, and Netherlands, etc., they held some of these assets which had gone down in value, and there were various things went on there. But as a share of GDP, the financial sector is much smaller in these countries. So, although the banks were affected, the overall effect on these economies was somewhat smaller. So that's why the effect of the deficits here is relatively small. For Germany, particularly small, and for France, minus 6%. That's big, but minus 6%. Going back to the UK, we've had 6% deficits in the recession around about 1990. We had a recession at the beginning of the 90s, and so in that period, for a very brief period, we had a figure of 6. So 6% is big, is a big peacetime budget deficit. But it's something that is not completely off the scale, whereas 8.9 or 10.9 is way off scale. Okay, and then we can see there's a gradual thing. These figures have gradually come down over time. So gradually they've inched down. So I've been giving this when I do this stuff. When I was doing it at the start, you had the big figure here, and each year I add a little bit extra onto it. So the last year for which I've got some complete comparable figures is there. So by 2015. So this is calendar year, by the way. The IMF do things by calendar year, whereas most UK publications do it by financial year, from April to April. But so for the UK, it was 4.4%, US down to 3.7%, euro area about the same as it was before the crisis. You can see there that Germany's actually had a budget surplus from 2012 onwards, and France, it's come down as well. So what's been gradually happening is that countries have been reducing these deficits that were generated by the financial crisis, and it's taken them some time. Now, you can say, so 4.4% is high for the UK, 2015. It's actually come down. So if you want to look up all these things, the Office for Budget Responsibility, for those of you who are interested in the UK economy, the Office for Budget Responsibility has loads of figures about what's going on, and these are the things that are usually reported in the press. And according to the Office for Budget Responsibility, in the financial year 2015 to 16, it had gone down to 3.8%, and 2016-17, which is the last one they have complete figures for, it's 2.3%. So 2.3% by last year, the last financial year, i.e. the one that ended in April 2017. So between April 2016 and April 2017, it was 2.3%. And the forecast for the current financial year, which is just about to end in a few weeks' time, it's about 2.2%. There should be a minus there. It's not a surplus. So it's 2.2%. So in a sense, you can say that the crisis is sort of over. So far, sorry, not the crisis is over, but that the deficits. Certainly, looking at it from a point of view of the government deficit in terms of deficit GDP ratio, that it's back to a period of normalcy, and that's why Philip Hammond was a bit more upbeat in his speech yesterday. So that's roughly what we've got then. So these deficits if we look at the deficits in terms of their level, we can sort of say these are sort of in the ballpark sustainable. We'll come back to the US a little bit later. These are sort of in the right sort of ballpark as sustainable deficits. France's is still a bit high, but it will have come down. I haven't actually got the figures for France, but I'm sure that they'll have come down below 3% by now. We'll come back to America. So, the problem was then that the deficit crisis was that these levels of these deficits were unsustainable, in the sense that if they'd have been maintained over time, they would have led to a debt GDP ratio that was ever increasing. So you can't have a deficit to GDP ratio of 8.9% without having the debt GDP ratio forever rising. So under ordinary notions of sustainability, this level, well, leaving aside Germany maybe, these levels of deficit are not sustainable, whereas the current levels of debt probably are sustainable. And in fact, if you've got a 2.2% deficit, that more or less means that the UK debt GDP ratio will remain constant, or maybe even slightly fall. So that's it. That's what else. That's a deficit crisis. Again, there's a picture which I've hopefully you've seen a couple of times. You ought to memorise this. Well, not memorise it, but if we look at UK national debt, so we're looking at deficits there. There's a history of UK national debt. As you can see from the beginning, it's from the inception of the Bank of England. So it rose and rose up until the Napoleonic Wars there, the Battle of Waterloo's round about here. So there were lots of wars with the French, and also the War of American Independence. And these were all financed by issuing debt, because there wasn't much taxation in those days. And that led to a very high debt GDP ratio. Obviously, this is economic history. Nobody was measuring GDP then. GDP hadn't been invented. These are the figures that historians reckon are based on figures from economic historians, which you can maybe take with a bit of a pinch of salt, but they're the best guesses we have. So that's certainly it was very, very high, and indeed Britain, the various income tax was introduced during the Napoleonic Wars by the British Prime Minister Pitt the Younger, and there was a lot of taxation and stuff, and indeed people felt themselves to be quite poor. This was the age of Charles Dickens. There was a lot of poverty around because Britain was having to repay this large national debt. But it fell down, the debt fell, largely because the British economy grew. And it fell down to quite a low level just before the First World War, but then it went up again and up again with the Second World War. But notice that there's a large part of the last 200 years has been spent with a debt GDP ratio in excess of 100%. So if we look at this map from here, from about the mid-70s, 1752, all the way up to 1862. If I got my, I can see that, can't I? Much clearer. Yes, up to about 1852. So that's nearly 100 years. The debt GDP ratio in the UK was over 100%. And also in the 20th century, from 1914 onwards, well, just before the First World War, I think. Well, yes, from then on, there had been a bit of rearmament before the First World War. But anyway, until 1952, our debt GDP ratio was over 100%. So we have been through quite long periods where the debt GDP ratio has been quite significantly higher than it is now, and we survived. So that's interesting. And indeed, you might say we prospered in the late 18th, early 19th century. So it's not all bad news. But obviously it's gone up quite a bit. So this thing finishes here at 2012, and it's gone up quite a bit. But we can also look at another country, which is Japan. So Japanese, basically, as I say, they had this crisis in the round about 1990, and as you can see, the debt has been going up since then. There's net government debt and gross government debt, two different ways. Basically, the green line is net debt, which subtracts off various assets. The red debt, the red one, is the gross debt, which is simply the sum of all the debts without netting anything off. But you can see the gross debt has shot up to a very high figure. Even net debt is pretty high. And it's continued growing in recent years. So this goes up to there. So in 2015, it was 230% of GDP. So that's a very high debt which they have in Japan. So the Japanese economy, is the debt a good thing? Well, I mean, the Japanese economy is sort of growing, not growing very fast, but it's not the end of the world. They are surviving, even despite this very high level of debt. So what's the maximum? What's the maximum that the country can afford? Well, this is really quite. There's no simple answer to that. You can sort of say, well, once debt gets above a certain level, it tends to be a bit of a drag on growth, because to fund the debt you have to raise taxes and things like that. Taxes tend to be distortionary, have disincentive effects, so it adds a bit of a drag on the whole economy, so you expect to probably grow a bit smaller. And Reinhardt and Rogoff, two economists who looked at this, they claimed that once you get to about 90%, you start getting this effect, this draggy effect on the economy starts kicking in. That was found to be a bit of a spurious result. A PhD student got hold of their spreadsheet with the data and found that there was some dodgy stuff on the spreadsheet. But certainly, at some level, maybe around about 100% or something like that, or maybe a bit longer, you might have these. It might have an effect on economic growth. But it's not. There's no hard and fast rule. If you look at Britain, when the British experience. Okay, if you look at the interwar period, when we had the high after the First World War, we had pretty slow growth then. But that wasn't necessarily caused just by the UK national debt. There were a lot of other things going on. And if we look at the 18th century, yes, we did have a very large debt, but we also the British economy, also was able to grow through this period. So it's maybe not the end of the world. And so what are ways of thinking about the cost of this? Well, you can think about what's the most the country wants to afford to pay in terms of interest. So you pay interest on your debt. Now, things are a little bit different now because of QE. We'll talk about that next week. But you need to take then a view about what is a long-run real rate of interest. So suppose that you had, suppose the most you were willing to pay out of your debt was about 10%. Now that's a lot. Just to give you an idea, if you look at British GDP, about government expenditure of various kinds, education, health, blah blah blah. That takes up about 40% of GDP, and you've got consumption and investment, the other bits, and the balance of payments. But 10% is like a quarter of what you're spending on public expenditure. So if you're going to pay 10% of your GDP in interest payments, now that would be equivalent to a quarter or a third of your expenditure on health and education. So if you're willing, but let's suppose you're willing to pay 10% GDP and the interest rate was 5%, that would mean that the ceiling will be round about 200% debt GDP ratio. i.e., if you had a 200% debt GDP ratio and the interest rate was 5%, then 10% of your GDP will be taken up simply with paying interest on your debt. If 10% is too much and 5% was all you were willing to pay, and the interest rate was 2.5%, you'd get the same answer. 200% debt GDP ratio. If you're only willing to pay 5% of GDP and the interest rate is 5%, real interest rate, then that would imply a ceiling of 100%. What sort of figures would you think about now with the British economy? What's the real interest rate? Well, it's a bit difficult because, of course, the Bank of England's keeping the real interest rate artificially low with quantitative easing. But sort of historically, you might think of a real interest rate of something like 2 to 3%. If you had a debt GDP ratio of 100%, which is higher than what we have, but that would imply that 2 to 3% of GDP would be going on your interest payments. Now, it doesn't actually necessarily mean, I've slightly exaggerated it here, because of course, who gets these interest payments? Well, if you look at a country like Japan, the main people who own Japanese government debt are the Japanese. So really, it's just a merry-go-round. You're not actually losing 10% of your GDP. It's just being redistributed, if you like. And it's the same in the UK. A lot of the UK national debt is owned by British people. So the interest payments on the British national debt are basically redistributing wealth from the people who own these, from the taxpayer, if you like, to the people who own the debt, which will often be the same people because pension funds and things like that have this debt. But that gives you an idea about roughly what you might do. But for other countries, of course, a lot of their debt might be owned by foreign investors. So if you like, that would mean that a lot of this interest payment might be going abroad. So it would be a real loss to the people who were living in the country. So there are actually a lot of political constraints as well. There's limits to taxation. So there's notions of the Laffer curve, that there's a maximum amount of tax that you can raise. But if tax rates beyond a certain point, an increase in tax rates will have a disincentive effect, so that although you're getting a bigger proportion of income's going down because people are working less, or there's less economic activity, and so that the Laffer curve would imply that there's an absolute maximum to how much tax you can raise. But more important than that, or well, not more important, but quite importantly, there are political constraints. There are limits to taxation. So if we look at British history, the attempt to recover the costs of things have led to lots of things. So, for example, the American Revolution. Why did the Americans revolt? Well, one of the reasons they revolted was that the British imposed tax on tea and some other things. Why did the British impose a tax on the tea? Well, they'd done that because they'd just fought the 7 Years' War. They'd defeated the French were in Canada, and we defeated the French in Canada. So Canada became part of the British Empire, and the threat, if you like, to the British the British colonists in America, in places like Boston, was removed. And in return for this, the British wanted to raise some money in America, and the rest is sort of history. The Americans didn't like that. Boston Tea Party, no taxation without representation, etc., etc. So the American Revolution was certainly one of its causes was the attempt by the British to raise taxation on the American colonies. And if we look at the period, as I say, after Waterloo, we had this huge national debt after the Battle of Waterloo, after 1815, and there was a lot of riots and sedition in this period. One of which here, which I've got depicted here, is the Peterloo Massacre. If you go to Manchester, there's a place called Peterloo, and basically the chaps on the horses, these are the not the police. The police force wasn't invented then, but sort of like National Guards, mounted National Guards, charged, and a crowd of 60,000 people, and 500 were killed, many of whom were women and children. So this was the Peterloo Massacre. So these sorts of things happened as a result of anti-austerity demonstrations. So, what's the current situation in the UK? Well, you can see the debt to GDP ratio has increased dramatically in some countries. And again, we can look at this, a selection of countries. So the black bit is the gross debt. The red bit is the net debt. Now, it's the IMF. I haven't actually been able to find anybody who knows exactly how the IMF calculate net debt. What they'll have done is they'll have a standardised method which is the same across all countries. The problem is each country, when you calculate net debt, the gross debt, everybody knows what the gross debt is. That's simply all of the outstanding bits of paper, the financial instruments, the securities and bonds and so on. So those can be measured very, very accurately. The question is, what do you allow to be netted off? What are the assets of the government? So, for example, in the UK, the Office for National Statistics only allows for very liquid assets to be netted off. So when you look at net debt in the UK, the figures that are in the newspaper, the net debt will be the gross debt minus foreign exchange reserves and cash balances of the government. So the government at any time has bits of cash to fund all its the money it's doing. So it has quite a narrow definition. In other countries, they would allow certain wider class of assets to be concluded. But anyway, here are the figures. I've just quoted them there, and here's the sort of level of debt that you've got, that you've got. So this is the US, the UK. So we see the UK. Well, when we were looking a little bit earlier last week, we were looking at the pre-crisis, and the debt before the crisis was more or less 40% or less. I think it just creeped over the 40%. Gordon Brown's golden rule. He just broke his own golden rule just before the crisis. It was like 42%, but it rose rapidly. It doubled in almost 3 or 4 years, and currently it's around about 90%. The figures that you often get quoted are less than that, because I say the headline figures are a net debt figure. But you can see it's more or less stabilised in Britain. It's more or less stabilised in Britain. In America, it's shot up. It's over 100%. and it'll be rising. We'll see that a little bit later. The net debt figures are slightly different. They have a different concept, which is the debt held by the private sector. In America, there's a lot of government institutions hold debt. Things for Medicare, Social Security, policemen's pensions, military people's pensions. And these are all subtracted off from the gross debt to get the headline figure. And the headline figure, for those of you who read the American financial press, is what's called the public debt held by the public, because they exclude all those sorts of things. I'm not sure. I don't think that figure may or may not be exactly equal to that. But anyway, we can look at some other countries and we can see pretty much the same thing happened. Germany, the debt went up, but it didn't go up by as much. So it was already, Germany had a much higher level of debt prior to the crisis, 67%, and it only went up by 10%. So it's a relatively modest increase in German debt. France, again, it had a much higher level of debt before the crisis, 70% higher than the UK, and that went up to the high 90s, and it's still going up. Remember that the French deficit is quite a bit higher than ours, so it's still going up, and it probably will have passed the 100% level by now. Haven't actually got the whole figures. And if we look at the Eurozone, it's gone up by quite a bit across the euro area. Japan, well, it was 191% back in 2008, and it's gone up to 249 now. But that's not caused by the crisis. That's simply, it's been doing that for a long time. Why is that actually? What's been going on in Japan? Well, whereas in Britain we took quite strong measures, maybe too strong, to reduce the deficit. In Japan, they haven't done that. They've tried to reduce it a bit, but in the end, they've learnt to live with their deficit, and they've just had this ever-growing public debt, and it'll probably keep on growing. Now, on any normal definition of sustainability, Japan's debt is unsustainable. So something's got to give, but nothing seems to have given yet. Partly that's because it's mainly Japanese people, as I say, who own this. So it's some sort of huge intergenerational transfer or something that's going on there. But that's it. As I say, I gave this talk in China. So we got some Chinese figures here. So you can look at developing non-Western countries and so on. They tend to have lower levels of debt simply because it's many countries can't borrow so advantageously as OECD countries. So Chinese debt's been increasing, but it's at a much lower level than the gross debt. It's increased at a much lower level than to a much lower level than what we have in the West. So there's increasing government debt in China, but it's not such a great at such a high level. So we'll have our intermission. That's well timed, and we'll come on to crisis 3 and look at some other factors, and I'll also give you a live, up-to-date account of exactly what's going on now. So we'll just break for 5 minutes. I've already had my sandwich, I'm afraid, but should give you time if you want to pop out, or just sit there, and we'll start in 5 minutes when your mind has been refreshed by the rest.
Okay, so Eurogeddon, so Eurozone crisis. So what is going on there? Well, if we look at the euro area in 2011, the total debt GDP ratio was, it's high, but it wasn't particularly. It was similar to what you had in the UK and the US, less in the US certainly. And if we look at the deficits as well in the euro area in 2011, it was high, but a lot less than what we had in the UK and the US. So if you were looking at 2011, at the eurozone as a whole, you'd say that Euroland was in pretty good shape, at least relative. This is 2011 is the crisis is still very much there, but that the Euroland or the eurozone, the countries which make up the euro, were in pretty good shape relative to Britain and America. And indeed, you could say they were even in a stronger case because they had a balance of payments surplus. Typically, the eurozone, since it's been first started, overall had more or less balanced payments around about zero or quite small. But with the recession, since then it's gone up. So it has a surplus. So it's selling more than it's buying with the rest of the world, which is quite favourable when you compare that to the UK and the US, where you have like a deficit in the balance of payments. X minus M is very much negative. So that's sometimes called, the UK and the US sort of double deficit countries. They have a balance of payments deficit and a government deficit as well. Okay, so what are the factors? Oh, here you go. Yes. So there you go. That's the stuff. But there are two sort of. So here are some of the figures. Deficit to GDP. So you can see that the euro area has consistently had a much lower deficit to GDP than UK and the US. But there are two factors that are different, or at least one factor really, but two factors which have interacted. One is the ECB, the European Central Bank itself, and how that operates, and the other is the internal imbalances. So the ECB, again, there are two main features that define a modern central bank. Manages the national debt, or at least underwrites it. And secondly, it's a lender of last resort, as I said, with budget. Now, as it was set up, the ECB was supposed to do neither of these, and it was set up to do that in this way by the Maastricht Treaty. The idea is that it just sets interest rate. So the Eurozone setup was to limit responsibility of national debts so that each country would be responsible for its own national debt. And the ECB was to play no role in managing national debt. It would issue debts, French debt and Italian debt, etc., Greek debt. But it's the French and Italians and the Greeks who would be responsible for paying it back, not the ECB. And secondly, the ECB wasn't supposed to have any direct role as a lender of last resort. The national central banks were supposed to do this. So the ECB could support them if they required liquidity, but at the end of the day, it was the national central banks that were supposed to do this, not the ECB. And this is sometimes said there's no banking union. The first bit is saying there's no fiscal union, and the second one is saying there's no banking union across the members of the Eurozone. And in fact, more than that, the ECB really wasn't able to print euros. I have to say, explain that a little bit. I mean, obviously the ECB can print euros, but only under very limited conditions. So the capital of the ECB, the working capital of the ECB, is basically provided by member states and central banks.
And so the ECB is not really a central bank like the Bank of England or the Fed in America or the Bank of Japan. It's a bit more like the IMF. So the IMF model, the International Monetary Fund, the idea there, or indeed the World Bank, is that the members of the IMF pay money into the IMF. They're like shareholders of the IMF, and then the IMF lends money out. So that the capital is provided by the members. So, Britain contributes to it, America is the biggest contributor, China contributes to it, France, Germany, they all contribute to the IMF. And then the IMF can then lend out money to people who need it. But the amount it has to lend out is ultimately determined by what's put into it by its members. And so the ECB was more or less designed along the same sorts of lines as the IMF. Now, in fact, this is really not necessarily a good idea. I mean, if we look at the IMF, there was a big debate between John Maynard Keynes and the Treasury Secretary after the Second World War in Bretton Woods about how the IMF should function, whether the IMF should function in this very restricted way. That was the American view. Or Keynes's view was that it should behave a bit more like a central bank to be able to create money. And in the end, the American sort of slightly more conservative view won out. But the ECB, why is the ECB being designed by this? Well, it was designed by this because of the Germans. Essentially, the Germans were always opposed. The idea of the euro had been around for a while, but it was seen as a distant dream that might happen in the distant future. But with the collapse of communism and the reunification of Germany, things sped up. The Germans needed to get, if you like, permission to reunify Germany. Some people thought it might be a bad thing. And as a sort of political deal that was brokered between the French mainly and the Germans, was that, okay, you can reunify Germany, and East Germany can just become part of Germany and part of the European Union. But you've got to fast forward, you've got to speed up the euro. So rather than being in the distant future, 20 or 30 years, it's got to happen in the next decade. That was a sort of deal that was cobbled up, and the Maastricht Treaty was the result. And the Bundesbank, they weren't too happy with this, because the Bundesbank has been a very conservative central bank, even in the crazy 70s, when there was a lot of inflation in France, Italy, Britain. German inflation was kept very much under control. And they were worried that they didn't want the ECB to be taken over by non-Germanic elements in the Eurozone. And so they wanted it to be a very restricted, limited organisation. And they wanted to prevent the ECB from just printing money and generating inflation. Or they didn't want the Germans to become liable for the financial, for the government spending or deficits in other countries. And that's sort of why it had this very specific things. Now, it was a very big treaty. I don't know if anybody read it. I don't think many people did read it. And sort of people forgot about it until the crisis. Because before that, most countries had been going along sort of more or less okay. But with the crisis, you've suddenly got a situation where quite a few countries in the Eurozone have these big public deficits. And that then raised the question, the markets before had treated all the ECB debt as if it were the same. So whether it was Greek debt, Italian debt, French debt, Portuguese debt, Irish debt, German debt, they all were treated the same by the markets, in the sense that the interest rates on those, the implicit interest rate on the Eurozone debt for each country was the same. And indeed, this was touted as one of the benefits of the euro, so that countries like Portugal or Greece, which historically had had
quite high interest rate premiums because people were a little bit sceptical of their ability to repay, were suddenly able to borrow at a nice low rate, which was the same as the German rate. And I guess the markets thought that the ECB, which was based in Frankfurt, nice big building, European Central Bank, it's a central bank, it sort of underwrites the debt. But of course, once the deficit came in, people suddenly started, well, is this right? And they started reading the small print of the Maastricht Treaty, and they realised, quite soon, markets realised that in fact, whereas the British Bank of England and the Fed were able to step in and introduce things like QE, quantitative easing, I'll talk about that a bit next week, the ECB wasn't supposed to do that, and that it was a real possibility that the Italians, the Greeks, the Portuguese, the Irish might well default on their debt. And so you saw the evolution of these big risk divergence, if you like, of risk premia across the Eurozone. So here we have the various countries here. Okay, there's Greece is the biggest one. So you've got quite a lot of divergence of the rates of return on the zone, on the bond yields, government bond yields. So whilst the German bond yields actually decreased, people saw the German debts as quite safe. For the other ones, the ones up here, Portugal, Ireland, etc., Greece, there was a big divergence away. And each country had a country-specific risk premium. So that's sort of what happened, more or less, in the ECB. So essentially it meant that European sovereign debt could be prone to a liquidity crisis. So ultimately, whereas the British debt, there's no question that the British government will not repay its debt, because at the end of the day, the Bank of England can always print some pounds, so that if you've got British debt, you're going to get pounds. If you've got American debt, you're going to get dollars. But with European debt, it wasn't clear. If the Portuguese government ran out of euros, it might not be able to pay its debt. And that's why you have this default issue. And that's created, if you like, by the nature of how the ECB was set up. It's a central bank by name, but not by nature. And that was the crucial point that led to this thing. And we've seen there is a real default risk here. There's a couple of cases where these things have gone wrong. For example, in Greece or Cyprus, where people who've been holding Greek or Cypriot debt have had haircuts. They've lost some of their assets. So it's actually been a policy that's been implemented. But as we'll see, the ECB sort of changed its behaviour, but we'll come back to that. There's also, within the Eurozone, a big internal balance of payments problem. So that you've got some countries, so this is looking over the period 2005-2010. So you've got some countries which are all blue, which have a balance of payments surplus. You've got Germany, Netherlands, Austria, Finland, Belgium just about, and you've got ones with the deficits, which Greece, Portugal, Cyprus, Spain, and some other ones, Ireland. So these are current account balances over that whole period as a percentage of GDP. And these are very high. These are pretty high. The Cyprus, Portugal, Greece, those are pretty high negative deficits. Germany and Netherlands, Luxembourg's small, so you don't need to worry about that. 8.4% of nothing is nothing. But Germany and the Netherlands are quite big. and they have these stonking great surpluses over 6%. And Germany's gone on to become I think it's the largest exporter in the world. It's overtaken China now. So you've got these internal balance of payments. Now, the internal balance of payments might not be a problem. I mean, if you look at America, you've got all these 54 states, I forget now. It's a continent, more or less, or a large part of a continent, North America. There are probably quite big internal balances within America. Some states are booming, some are contracting. But those balances can be dealt with more easily when you have a fiscal and a monetary union. Here you've got a monetary union, so the money's flowing between different countries, but it's not so easy to deal with because if there's a balance of payments surplus, it means, in theory at least, that money should be flowing into Germany, and that money should be flowing out of all these other places. Now, in practice, that didn't happen. It's another story. But clearly, it sets up internal pressures within the Eurozone, which are difficult to resolve in the way that the thing is made up. A part of the reasons for this is because there's been a big change in relative prices. So we can look at a period of how prices have evolved over this period. It's a bit of a longer period here, but this was in the run-up to the Eurozone, up to the crisis. So the Euro came into being in 2000, was it 2001? 2000, round about that period anyway. And there was a run-up before it. So over this whole period then, from 1995 to 2008, just before the crisis, in some countries there have been huge increases in prices. Greece, Spain, Ireland. Whereas in others, there's only been extremely modest increases in prices. Germany, Austria, Finland. It's the same sort of suspects you can see there. So a lot of these countries had seen a lot of price inflation. Now, some of this was just equilibrating, if you like. Greece and Spain would have been quite cheap in terms of the cost of living relative to Germany at the euro exchange rates, the pre-euro exchange rates. But certainly a lot of people have argued that they became a lot less competitive and they sort of overshot. So I don't know if any of you have been to Germany recently, but if you go to Germany, it's even cheaper than it is here. You know, if you go to Berlin, everything is cheaper than it is here, even with a low bit of sterling. Whereas if you go to the Republic of Ireland, if you go to Dublin, it's a lot more expensive. So I'd recommend, if you go on holiday, go to Berlin rather than Dublin. You'll have a much better time. So Germany now is one of the cheapest countries, lowest cost of living in the Eurozone, whereas that's not the case. Oh, one of the lower ones, sorry, in some of these others. So what happened then? So you had these internal balances which had interacted, if you like, with this notion of the ECB. Well, what has happened is the ECB has actually started to behave like a central bank. So it stepped in. The first thing, it stepped in with Mario Draghi. Whilst the governments were dithering what to do, the ECB just went ahead and simply did stuff. So it introduced outright monetary transactions, which was nicknamed the Big Bazooka, that the ECB was basically going to act as a lender of last resort to governments and was going to buy up sovereign debt if necessary. So the plan was to buy unlimited quantities of government debt from troubled members of the single currency. So it was like they offered to underwrite it. It was an offer to underwrite it in the same way that ultimately the Bank of England and the Fed ultimately underwrite British and American debt. So initially this wasn't QE, it wasn't quantitative easing, it was simply offering to buy up the bonds of troubled countries with up to large amounts. It subsequently did introduce quantitative easing, but it did that at a later stage.
But that was the immediate thing. So outright monetary transactions. Now, this was against the law, if you like. And in fact, some people in Germany took the ECB to court. And the German court said that, yeah, okay, it's against the law, i.e. against the Maastricht Treaty, against EU law. But then the German court simply sent it to a European court where it's probably... I mean, in effect, nobody really, although some people were very much against this policy, particularly in Germany, no politicians are willing to oppose it. Why weren't they willing to oppose it? Well, they'd have had to put an alternative. And the alternative would have involved using taxpayers' money. So it would have been quite unpopular. But there was a second strand that was introduced, which did involve taxpayers' money, or at least the guarantee of taxpayers' money, and that was the European structural mechanism. So that was sort of set up at the same time as the ECB was doing its outright monetary transactions and its offer to buy up debt. And this was the European Stability Structural Mechanism, which was funded by governments. So the idea was, like the IMF, governments in the Eurozone put money in, or at least offer to put money in. Again, it's sort of like by offering to put the money in, it makes it seem the money's there and sort of soothes markets. And then if governments were in trouble, they could apply to the European Structural Mechanism and get something and borrow some money from it. A bit like the IMF. So that's what happens with the IMF. A country gets into problems, it goes to the IMF and asks for some money. The IMF comes along and says, okay, we'll give you some money, but you've got to do some stuff that we want you to do. Privatise some industries, do something. And the ESM was a bit like that. And in fact, the ESM, the idea was that it would act like a European version of the IMF, and it would actually act in coordination with the IMF. So that a country like Cyprus, for example, or Greece, the ESM would operate with the IMF and indeed the ECB, sometimes called the Troika, to agree what to do with the country that applied. Needless to say, not many countries have applied, because usually they want you to do things that you don't want to do. But Greece had no choice, unfortunately. So what happened? Well, this is the same map, but we've moved on a little bit. So we saw the bit there where there's a lot of stuff going there. There's a fewer countries here than the previous one, but it's the main one. What's happened is that essentially the bond yields have come together. There's still a divergence, and that divergence is there because now markets understand how the Eurozone works, and they realise that governments can default, potentially, and so they are they're treating the debt of the different countries differently. Before that, they didn't used to do that. They just treated them all the same. So, if you like, markets are a bit more efficient now, a bit more rational than they were before, and that's because they understand now much better how the Eurozone system works, and that it's completely different. It's not the European Central Bank is more limited in what it can do than the Bank of England or the Fed. Having said that, of course, in practice, because politicians are unwilling, European politicians, Angela Merkel and Mr. Macron or his predecessors, they're unwilling really to take on the ECB because they'd have to have some alternative. So they are letting the ECB do lots of things which are outside of its narrow remit. But so it has sort of solved the problem, at least for now, of the Eurozone. The underlying imbalances, have they gone away? No, not at all. They have gone away to some extent, because a country like Portugal now has a balance of payment surplus. The reason it has a balance of payment surplus is because the Portuguese are a lot poorer now than they were. Their GDP went down quite a bit. And so now Portugal's even cheaper. Lisbon's even cheaper than Berlin, so
My second choice for a holiday destination would be Lisbon, or in Portugal, and Berlin would be number one. But so there have been some changes in the Eurozone. But the internal imbalances are still there, and so some people are arguing that really just that there'll be another crisis in the Eurozone down the line, 5 years, 10 years. And it could be like this. It could simply be some other crisis will come along and shake up the Eurozone and put more stress on it. And so long as critics of the Eurozone, would argue that unless you go towards a full fiscal union, like you have in the United States, then it won't ultimately. It'll be a relatively weak institution. I think they exaggerate that, because I think the ECB, if the ECB is made strong enough, it should be able to deal with most things. But clearly, where fiscal redistribution is needed across countries, it's quite difficult to do that unless you have a fiscal union. So that's the conclusion then. So Eurogeddon isn't really caused by high debt or the overall condition of the Eurozone. The Eurozone was if anything, in a better position than Britain or the US post-crisis. It was caused by the crisis, but also by the gradual build-up of internal balances. Coupled with what I've called institutional Luddism here. What I mean that I'm referring to Luddites. Those were some people in the early 19th century in Britain who used to go around smashing at machines. So essentially, it's the abolition of the central bank. It was not using the modern institution of the central bank and going back, if you like, to an earlier period. It's almost like going back to the gold standard, if you like, of having a very limited central bank that wasn't supposed to fulfil the usual functions of a central bank. So I've called that institutional Luddism. In a sense, it was trying to do without a central bank. And all of these things were laid bare by the increase in deficits by Crisis 1. So the Crisis 1 laid bare these internal problems of the euro, but they were there like a ticking time bomb. They were just an accident waiting to happen, and the deficits sort of caused everything to unravel. So the sort of solution to the problem, as I say, is at least to get the ECB to act like a central bank, and to some extent it is under Mario Draghi at the moment. And possibly it might need to go a little bit further in having more fiscal integration between the existing members of the Eurozone. And there is to some extent that might happen. But obviously it's politically quite difficult to get voters in different countries to all agree on how to do that. So let's come back to the US and the UK. So the UK, we've had quite a lot of inflation in the UK. So if you look at nominal GDP, if we look at the period 2007 to 2012, there was no real GDP growth. So 2012, quarter four, let's call it the beginning of 2013, that's when real GDP got back to its peak level in 2007. So there'd been no growth over that period of 5 years. But we'd had quite a lot of inflation, 13% over that period. Now, where had this inflation come from? It's a lot more than what you saw in America or in the Eurozone. And partly that's because after the crisis, pretty much within the next 18 months, we devalued 20% against both the dollar and the euro. One happened before the other. I can't remember which one was first. But anyway, we had this 20% devaluation against both. And of course, this kick-started off a wave of inflation, as we've seen recently in the recent devaluation post the Brexit vote. And inflation actually got up to 5% in this period, 2011. So it's quite significant. So the effect of inflation actually had quite a big effect on the debt-GDP ratio. So the debt-GDP ratio, it's a ratio of debt to GDP. The GDP is measured in nominal terms here. So if there's a lot of growth in nominal GDP, it'll tend to reduce the debt to GDP ratio. Now there's one caveat here, which is that it depends what's happening to interest rates. So we'll talk about that next week. This same period, we've had a period of negative real interest rates where interest rates have been artificially low, which has meant that real interest rates have become negative. And because of that, what's sometimes called financial repression, UK debt GDP ratio is about 12% lower as a result of this inflation. But so that's something that didn't happen elsewhere. We can look at inflation rates across the globe. If we've got the United Kingdom there, we're towards the higher level. If you look at the US, it is the red line. It's quite a bit lower. I mean, it still went up, but it's been a bit lower, and likewise the Eurozone. Japan's hardly had any inflation at all. Hasn't had much inflation for a very long time, and so on. And there's a picture of real and nominal GDP. So the thick line is real GDP. So as you can see, the Great Recession, it wasn't a massive impact. The output didn't fall by 20% or 10%. I'm not quite sure exactly how much it fell there. Probably about 5 or 6%, something like that. The blue line is nominal GDP. Now they cross here. That's simply because I've chosen. It's an index, so the way it's written, they've simply chosen to have the index so that they're both equal to 100 around about 2012. So don't worry about the position. The point is that nominal GDP rises faster than real GDP, and it must do if you have inflation. So the growth rate of nominal GDP is equal to the growth rate in real GDP plus the inflation rate as an approximation at least. But there's less inflation in the US, but there's certainly been better growth. So here we have the two recessions. We've got the US is this line, the red line, and the blue line is the UK. And as you can see, the US has recovered better from the recession than the UK. If the UK had followed the US, it would be quite a bit higher. Now, one way of interpreting this, one way of saying this, looking at this, is really saying that the main difference between the UK and the US is that in the UK we had austerity. George Osborne, there were quite strong attempts to bring down the deficit. And to do that by cutting expenditure. That didn't really happen in the US in the same way. Partly it's to do with the politics of the United States. It's very difficult to raise taxation in the US. And in Britain, there was a big rise in taxation as part of austerity. And in the UK, we've got a bigger share of government expenditure in GDP, so it was easier for us to cut expenditure. I say easier, it was unpleasant, of course, but we did cut expenditure, whereas in the US, there was less to cut, really, and they were busy fighting wars and various other things, so nothing much happened. So there was less austerity in the US. So you could say that the US is a country which didn't pursue austerity. It recovered more quickly. The UK, we did pursue austerity, possibly too vigorously. So that's what the criticisms of the George Osborne's period as Chancellor, they would say it was too much austerity. and it's led to a slower recovery from the recession than in the US. Now, I'd just like to say, when you look at the figures, to judge whether there's been austerity, you don't look at the deficit, because of course the deficit depends on expenditure and revenue. And of course, in the US, the deficit's been falling, pretty much the same as it has in the UK, maybe not quite as quickly. But of course, that's because the revenues have been rising because of the extra economic growth. I'll leave that out, but there is we don't need to worry about that so much. About refinancing, it's a bit of a technical issue, so I'll leave that one out. What about some more issues in, what are the issues now? Well, I just want to talk about a couple of things. One is real interest rates. Now, I talked about, so a real interest rate is the nominal rate minus inflation. So that's the Fisher equation. And there's a question now about what is the equilibrium or long-run interest rates. So some people have argued that these have fallen. It's sometimes called the secular stagnation hypothesis. So if you go back to the 1980s or 70s, the real interest rate, well, not the 70s, but if you go back to the 80s anyway, the real interest rate might have been 4%. More recently, it's been about 2 to 3%. And some people have argued that it's sort of falling, maybe fallen further. So the Bank of England did a study a few years ago, and they thought it might be 1% now. And some people argued it's even less. So there's an idea that the real interest rate, as equilibrium real interest rate, has fallen. Now, a lot of this, but I think the argument of whether or not that's true is a bit difficult to say, because the real interest rates, nominal interest rates at least, are largely determined by the central bank, and that the high real interest rates of the 80s were basically due to the fact that the bank was trying to control inflation in the 80s, the conquest of inflation that we saw in a lecture, the first lecture of the series, and there were very high interest rates in order to do that. Whereas, more recently in the Great Moderation, since the mid-90s up until the crisis, the central banks didn't really have to do much to control inflation. Inflationary expectations were governed by the delegation of monetary policy to the central bank, so that they were at 2 or 3%. So you might want to argue that really arguing for a long-term decline in interest rates isn't really. It's capturing different central bank policies rather than anything underlying. And I think I would agree with that. I mean, real interest rates may have fallen a bit, but they're certainly positive and not negative. They've been negative for recent years, and again, that's largely due to policy. The fact that the central banks, the Bank of England and the Fed, have been keeping interest rates artificially low. So what should happen in the future then? What's going to happen in the future? Well, when we go back to normal, there's an inflation target of 2%. The bank may raise that, but certainly it's currently 2%. So if you think that we're going to go back to the historical one of 2 to 3%, then the nominal interest rate should be the inflation target plus 2 to 3%, i.e. 4 to 5%. So we should be looking to interest rates going back to 4 to 5%. If you believe in stagnation, then maybe it'll just be 2 to 3%. So that's what should happen. And we'll see. The Bank of England doesn't like to say that this is going to happen. And in fact, Mark Carney doesn't like to raise interest rates at all. But I think he's going to be forced to. And that's sort of what should happen. What about growth? Back to what? And here there's another argument. Along with secular stagnation, some people have argued that growth may be going back to what it was in the past. So there's a period 1800 to 2000. This is taking a long view. We had the Industrial Revolution. We had various things happened. So the notion that the economies can grow in the long run at 2 or 3% might be an exception, and some people have suggested that really we'll end up with this secular stagnation, that growth will stop. So there's a cartoon. Again, I don't think this is correct, and certainly if you look at the world economy, it's certainly not correct. So the world economy fluctuates a little bit, goes up and down, but the average growth rate for the last 20 or 30 years has been 3%, and that's still 3% now. Okay, Western economies, America and Europe, aren't doing too well, but they make up about half of the world, but the other half of the world's been doing quite well, and they tend to cancel out. So the thing is, from a global perspective, I don't think there's any argument that this is that the growth rate has gone down post-crisis. It's simply that those countries, some countries have been very badly affected, like Britain and the US and Europe have been quite badly affected by the crisis, and we're doing quite badly. But there are other places that are doing quite well, and when you add them all up, growth rate is still around about 3%. And in Britain as well, we can notice that the British, I'll come on to that in a couple of seconds, but our growth rate's recovered, maybe not back to the 2 to 3% range, which we've had in the past, but certainly in the 1 to 2% range, so it's certainly going to be growing. I think the current forecast is something like 1.7% over the next few years. So that's something which is... So growth is coming back, and likewise in America. So I think there was some pessimism a few years ago, but the pessimism will disappear as growth tends to re-emerge. And why will growth re-emerge? Well, there's underlying technological progress going on. So technology is improving all the time, and at some stage that will generate economic growth, I think anyway. But I think the real problem is to do with income distribution. This is something to be a bit more pessimistic about. So if income becomes more unequally distributed, this causes problems. One of them, if you have a utilitarian perspective, if you think that social policy should be based on adding up the utilities of the individuals in society, there are problems in how you might do that. Inequality becomes inefficient because essentially, if you have a growth of inequality, it means that more money is going to rich people who have a relatively low marginal utility of income, and money's being taken away from poorer people who have a high marginal utility of income. So I like to think of it, a billionaire is like a black hole in space. They just suck in lots of money. And it doesn't make them any happier because they can already do as much as they like. So Jeff Bezos is 112 billion, I think, dollars. Well, an extra billion here or there doesn't do anything for Jeff Bezos, but it takes away a lot of stuff from other people. Jeff Bezos, he's the guy who runs Amazon. So that billionaires are a little bit like black holes, and it is a bit of a problem. And we have the following phenomenon, which is the elephant diagram. Branko Milanovic has done this, so everybody should know what the elephant diagram is. So what he's done is he's looked at the world distribution of income from the bottom decile to the top, and he's looked at who's gained, how much each decile has gained since 1988. And if you do that, you get a picture that looks like this, which he calls the elephant diagram. I'll look at the real thing here. So this is from his book. So what you see here is that a lot of people have gained a lot in the last 30. Well, it goes up to 2008. He hasn't done the figures. It takes a lot of these things come in with a big lag. So over that 20-year period, there's a huge increase in income, and this is mainly in incomes in emerging economies. And of course, the biggest one there is China. So in 1988, people were quite poor in China. Now they're a lot richer, well, a lot less poor. Some of them very rich. And these are emerging economies. There's very poor people. Well, very poor people, they've remained very poor. They were poor in 1988 and they're still very poor. So nothing much happened there. But you get this interesting thing here. You get this, the very rich people. They've done great. The global elite, they've done very well. But then you get all these people who are sort of, if you like, the middle class of the developed world. Middle class is used in its American sense, which means, I don't know, most people. But it means middle class people in the developed world. And they've done quite badly. Some of them are actually worse off than they were in 1988. And some of them improved a bit, but not very much. So there's a decline, if you like, of the developed world middle class. So that gives you the elephant trunk, the U shape there. So that's if you like, global, what's happening with global inequality. So there's good news. A lot of people now are a lot better off than they used to be 30 years ago. But income has stagnated for a lot of people in the developed world. And, of course, this has given us, some people would argue, the new populist politics in the West. Brexit and Trump. There you go, I like that. It's a good picture of that. Right. So my final comments then are that we've got three crises, all set off by the... well, I will conclude just with a little bit on what's happening, but one has to do... there's three crises. They're all set off by there's a financial crisis. Okay, and that's it's more or less finished now, the recovery of banks, etc. Although Royal Bank of Scotland is still hasn't been sold back to the private sector, but there's certainly post-bubble recovery of banks. It's taking time. It's over a decade because banks have to increase their capital base and so on. So banks are still not lending in the way that they used to before the crisis. There were big deficits that were caused by the recession. Same cause, but it's a different thing. And Eurogeddon, which is after the big deficits, you had the unravelling of the Eurozone, which has been patched up, possibly only temporarily, we'll wait and see, by the ECB. But it's something which is may re-emerge. Okay, so we live in a world in which Western economies have large debts. So that's, it's a new period. These countries are going to have to live with their large debts. At the moment, they're not really worried too much about it because of quantitative easing. Interest rates are very low. But as interest rates go up, then these debts will have to be funded, and that will cause lots of fun and games in the politics. But it's happened before in the UK, so I guess people will cope with it. And maybe there should be a shift in focus away from growth to distribution, because income distribution changes have had quite significant, have become much more important. I'll just finish with a couple of things. I'll just mention it. If you want to, where are we? If you want to find out what's going on in Britain, there's the best source is the Office for Budget Responsibility. They have a lot of present data, and what I just want to do is just show a couple of pictures, really. I had a picture there. Yeah, so here we have. I'll just go in here. Sorry, I didn't have time. It's only just published recently. Here's roughly what's going on in the economic forecast, for Britain. Okay, so you can see there that here's the growth rates that they're forecasting. So they're actually quite pessimistic growth rates, really. They're saying that it's going down from like 1.7% last year, and it's going to remain low in the mid ones, between 1 and 2%, a bit nearer 1% for a while. So that's quite pessimistic output growth. Historically, we're not returning to the norms previously. The GDP. Let's have a look. That's the forecast. GDP per capita. Yep. That's the main thing. In terms of they haven't got it here, but they've got another figure there, which is showing that the debt to GDP ratio is going to start to fall, that the deficit is going to be sufficiently small so that it'll stop increasing and in fact will start falling. So that's a good thing. That's roughly what's happening in the UK. If you want to look at what's happening in the US, there's the equivalent thing which is called the Congressional Budget Office. So I'll just take you a couple of seconds. And these things, well, it's on the front page actually. They're a bit better. They've actually got the figures there. But here's the what's projected. They haven't published the one for this year, so it's a year out of date. So it doesn't include all the stuff with the Trump tax cuts. But you can see there that there's quite a big deficit there between the US budget deficit is going to get bigger over time. And in fact, I think the figure is it's going to go up to like 5% of GDP. So the US is pursuing a very different trajectory to what's going on in Europe and in Britain, where we've got we've gone back to what are historically small budget deficits, which are less than 3%. They're going for broke, the Americans, and particularly after the Trump budget cuts. So it'll be interesting to see what happens there, and it's following a very different trajectory, but we can look at their forecasts of growth. If you can look there without the figures, you can just see that they're forecasting that US growth will be about 2%. So again, American growth is recovered, but it's still, it's not bad, but it's still a little bit below what it was before the crisis. So you can see pre-crisis, there were periods, when it was growing quite a bit faster, 4%, 3%, what they're forecasting. So there is a notion that maybe growth will be a little bit slower in the future than it has been historically, but it's a bit more normal than in the UK, where our expected growth is going to be quite weak and anemic over the next few years, according to the Office for Budget Responsibility. Anyway, I'll leave it there. Thank you. So I'll see you next week when we look at the UK monetary policy in the years since 2008.